China's deeply indebted property developer Evergrande has filed for bankruptcy protection in the US. Known as a Chapter 15 filing, it protects the foreign company's US assets from hungry creditors. Evergrande is on the hook for $31.7 billion owed outside of China, about a tenth of its total $300 billion in liabilities. The firm is planning a major restructuring of all it owes, negotiating down what it needs to pay back. But however that process proceeds, the overall outlook for China's property market is looking more dim and more grim, along with the rest of the economy struggling with high youth unemployment on the one hand, but also falling or flat prices for new homes. Real estate accounts for about a quarter of China's GDP. For more on this now, let's go to Russ Mould. He is Investment Director at AJ Bell in London. Thank you for joining us today. Russ, given the huge importance of the real estate sector in China, what impact can something like this have on Chinese and global growth?
On Chinese economic growth, the impact could be considerable. The Chinese authorities actually tried to take some of the heat out of a speculative residential property market a couple of years ago and have clearly done perhaps a better job than they thought. And with property being such a big part of the economy, some economists are even wondering whether this is China's Minsky moment, named after the economist Hyman Minsky, whereby there's a serious crash in the Chinese property market. If that were to happen, I've no doubt that shareholders and bondholders would lose their money, but the government, the authorities in China, would look to step in to support householders and probably end up owning an awful lot of property. What would happen internationally? It would be bad for raw materials demand, for copper and industrial metals and maybe oil and gas. But in terms of trade, China has a big trade surplus, so it actually sells more than it buys. So the impact there might not be quite as big as perhaps we would fear.
Right, we're seeing reports of Chinese authorities as well encouraging certain companies to buy back their own shares in an attempt to support prices. We've also seen a devaluating currency there in China. Are you concerned? Citi has talked about a potential Lehman moment for China.
Yeah, I mean, I think that's the Minsky moment argument, isn't it? That you have a very speculative bubble in property that's been supported by cheap debt that could collapse. The Chinese authorities, we've seen the People's Bank of China cut interest rates this week. Whether that will be enough, I doubt it. And then that leads China to another conundrum, which is the more it cuts interest rates, the more its currency may weaken. And you've actually seen China look to try and support its currency. So whether it can actually try and achieve economic stimulus through lower rates and support its currency at the same time, that will be very difficult, which again leads you back to the conclusion at some stage the Chinese authorities will have to step in and provide some serious support to consumers, perhaps directly through fiscal stimulus and indeed by getting involved in the housing market itself.
Russ Mould, thank you very much for your analysis. And now let's go to the top stories from around the world. Japan's inflation has slowed in July, reaffirming expectations the Bank of Japan will be in no rush to make a historic shift in monetary policy. The core consumer price index, which excludes volatile fresh food prices, rose 3.1% year-on-year, following a 3.3% increase in the previous month. The slowdown was mainly driven by falling energy prices. US mortgage rates rose to the highest level in 21 years this week. The 30-year fixed-rate mortgage averaged 7.09%, and that's up from 6.96% the week before. The rate has gone up by almost 2% since last year in the same period. Mortgage rates have spiked as the US Federal Reserve continues to hike the federal funds rate, which currently moved up to 5.25% in July. And Walmart is winning over US shoppers as its low price model continues to attract budget-conscious consumers in a tough economic environment. The world's largest retailer posted same-store sales that rose 6.3%, beating expectations. The company has also raised its outlook for the remainder of the year, a signal it expects its strong run to continue.